helpful. So thank you.
Okay. Good afternoon. My name is Jean Carr. I'm the Executive Director and Chief Investment Officer of ERFC. So I'm covering today the annual State of ERFC presentation. We've given this presentation to the school board for the last 10 years or sent it to you so that you know what the status of ERFC is. I want to acknowledge our senior staff members that are here today. We have Jim Rohner, who's our Deputy Executive Director, Michael Lunter, our Finance Coordinator, and Lisa Scott, our Communications Specialist, with us here today, who've helped us with this presentation. I also want to thank the ERFC Board of Trustees for its thoughtful input during the year. We have several of our trustees present here today. We have Michael Hairston, who's our chairperson. We have Susan Quinn, our treasurer. Also Kristen Michael, Dr. Lockhart, and we have Michael Burke here, who is our appointed trustee to the board. He's served 2 years on the board, and we're happy that he's agreed to begin his third term. He's also the managing director and head of the East Region for the Wealth and Investment Management Division of Barclays. So he has more than 25 years of experience in the investment area, so his expertise has been very invaluable to the board. And then I also want to acknowledge Leonard Bumbaka, who's not with us here today, but he's ending his term after 15 years on the Board of Trustees. He was our chairperson, vice chairperson, and has served on several of our committees. So he saw ERFC through many changes over that 15-year period as we combined our finance group and our member services group, and also was responsible for a lot of our initiatives on our strategic plan. For the agenda this afternoon, I'm not going to go through all the slides here, but I will cover the statistics on our membership, our current trends. I'll go over our financial status and results in terms of our investment returns and our funded ratio. I then will cover information on our risk assessment, our historical administrative expenses, information on the Board of Trustees governance practices, some of our accomplishments during the current fiscal year, and then what we have planned for FY16. Just as a review for you all, the ERFC is the supplemental retirement system to the Virginia retirement system. It's funded by investment earnings, by contributions from the employees, and by contributions from FCPS. So investment earnings are typically the biggest contributor. They were a contributor of $102 million in 2014. The employees put in 3% of pay, which was $40 million, and FCPS contributed 5.6% of pay, which was $74 million. So it's definitely a system that's supported by both the employees and FCPS. It's in contrast to the private sector, where very often there aren't employee contributions to the defined benefit plan. It is worth pointing out that if this was a pay-as-you-go system, we would be paying 11.69% of payroll rather than the total of 8.6% that we're paying today. So I know, as Mr. Stork has pointed out in the past, it is important that this service currently rendered should be paid for by the current generation of taxpayers and not an expense passed on to future taxpayers. There are two plans within ERFC. There is the legacy plan. This was designed back in 1973. It's termed an offset plan. It's a very complicated design. You don't see much any longer, but it requires us to come up with a Virginia retirement system contribution Virginia retirement system benefit that we offset, and also a Social Security benefit that we offset at full Social Security age. In 2001, the school board put in a new plan called the ERFC 2001 plan, much more streamlined, very simple to calculate. It simply takes your years of service times a multiplier times your final average salary. It doesn't have a lot of the bells and whistles of the legacy plan, no sick leave credit, no disability provision, and you can't purchase service in the ERFC 2001 plan. On slide 4, we show that we have almost 3/4 of our members, 73% now, in this newer ERFC 2001 plan. So it has eventually become the predominant plan. In terms of retirees, though, not so much. 10,000 retirees still in the legacy plan, and we only have 5% of our retirees, 518, in our newer 2001 plan. So we're not retiring very many yet from the newer plan. On slide 5, we show the differences in demographics between these two groups. So in the legacy plan, the average age is 53. They have 18 years of service. So they're not really going to meet how this plan was designed. The plan was designed to be able to retire at age 55 with 25 years of service. That's when you're entitled to a full service benefit. These members that are in the plan now are not going to achieve that, so they're not going to have the 25 years of service when they reach age 55. Our average member in the 2001 plan is only about age 40 with 5 years of service. So you can see when we're developing our communication programs, we really have to take into account the significant difference between the members that are in the legacy plan and in the ERFC 2001 plan. Slide 6 then shows the characteristics of our retirees. So the average age that a retiree is retiring is increasing over previous years. Back in 2004, the average age was 58, and now the average age is increasing to almost 62 years. So that's a 4-year increase, significant increase in retirement age over that period. The average retiree exited at 52% of salary. So if you take the combination of the ERFC benefit, the VRS benefit, they're going out at 52% of pay. The average retiree in the ERFC 2001 system is only exiting at 20% of salary, but keep in mind this is a newer plan. The average retiree only has 8 years of service, so that is why that salary percentage is much lower. Now we've talked about the change structure of ERFC in terms of the legacy plan and the ERFC 2001 plan. I also wanted to spend a few minutes talking about the change structure of VRS. So we show here the VRS plan along with the ERFC 2001 plan, the ERFC 2001 plan being constant. We're profiling our average member who's now age 62, has 22 years of service, going out final average salary of $75,000. So if you see the Plan 2, which was initiated for those members hired between July 1 of 2010 and the end of 2013, there's a significant reduction in the benefit for this member if they are a Plan 2 member rather than the original Virginia Retirement System plan. So they only will be entitled to a benefit of $20,690 in contrast to the Plan 1 person who would have $28,050. So that's almost an 18% decrease if you were in Plan 2 instead of Plan 1. Now, if you look at the newer hybrid plan, which was just put in for those employees that were hired on January 1, 2014 or after, we've portrayed here two different members in the hybrid plan, one who's putting in the maximum contributions and one who's only putting in the minimum required contribution, which is 1% of pay. So that individual that's putting in the max, and remember that individual is going to have to put in 9% of pay in order to get that max, they can almost equate to the benefit that they would have had as a Plan 2 member. So the combination of converting their lump sum benefit in the defined contribution portion to an annuity would almost get them to Plan 2. If, however, they were only putting in the minimum, which is 1% of pay, their benefit would be further eroded from what they would have had in Plan 2. So another almost 18% if they're not voluntarily putting in additional contributions. Now, you probably can realize that we had to make a lot of assumptions in putting together this chart. We had to make an assumption regarding what the employee would earn in the hybrid plan, in the defined contribution plan, and then how we would convert that lump sum to an annuity. So we assumed that they would earn 5% because ERFC assumes it will earn 7.5%, and we looked at a recent report from the National Conference of Public Retirement Systems that says an individual in a defined contribution usually earns about 2% less than somebody in a defined benefit plan, and they pay about 0.5% more in investment expenses. So we used that 5% we thought as a good bogey of what an individual would receive in a defined contribution plan. And then we converted the $178,000 that they would have at retirement to an annuity by using some quotes for annuity conversion from Vanguard. So we think that our assumptions are valid, but you certainly could use very many different assumptions on doing this conversion. Now, it is interesting to know that as of April 1, FCPS had 1,088 members in the hybrid plan, but only 13 of those were making any voluntary contributions. So they were just making the 1% that they were required, but they weren't putting in any additional contributions. So the second topic on the agenda was our membership trends. And if you look on slide 10, it does take a long time for a newly instituted plan to become the dominant plan. So it wasn't until 2007, that was after 6 years after 2001 was enacted, that the membership was greater than the legacy plan. And we now have, as I said, 3/4 in that plan. The total membership declined by 1.3%, or almost 300 members in 2014. So certainly a result of staff reductions, we're having fewer new members in our defined benefit plan as well. On slide 11, we show our retirements for the past fiscal years. If you remember, during the financial crisis, we had significant declines in our retirement numbers, so those numbers went down in 2008, 2009, and really didn't come back again until 2012. So we have seen a significant uptick in retirements since that time, 610, 602, reaching a high of 669 last year. The number you see on the chart here for this fiscal year is only through April. Now, our numbers as of this morning were 612 for this fiscal year. So we're not going to have as many retirements as we did last year, returning more to the 13 and 12 levels. We do have 417 applications for July 1 of our new fiscal year. So those July retirements are up by about 9.5%. It's kind of difficult to predict human behavior and how many are going to retire. We do have about 1,700 members that are eligible for full service retirement, half of them in the legacy, half of them in ERFC 2001. And we do have 500 members that are aged 55 with 25 or more years of service, so they are meeting that bogey for which the legacy plan was designed. Looking at the next slide, these are the benefits that are paid out to our ERFC retirees. So we paid out $158 million worth of benefits in 2014. Many of these benefits remain in the Commonwealth of Virginia, about $114 million, so they are providing a valuable economic benefit to the state. And almost half of our retirees live in Fairfax County, so $73 million of that remains as revenue in Fairfax County. That's only ERFC, so it doesn't include the VRS benefit. If you were to include the VRS benefit, there would be another $200 million worth of revenue to the Commonwealth of Virginia and $100 million remaining in Fairfax County. So significant economic flow-through of the retirees that are being paid into the county. So that really covers our membership and our current trends. I'm now going to go over the financial results that ERFC has achieved in the last recent periods. Slide 15 indicates our returns for the last 1, 3, 5, and 10-year period, for the period ending in March. And the board really has 3 goals. Number 1, they want to meet their actuarial earnings rate assumption, which is 7.5%. And this is about an average earnings rate assumption across the country. There was a recent survey by Arve Coons and the 2014 National Council on Public Employee Retirement Systems that said the median plan assumed that they would return around 7.5% or 7.7% respectively. The second goal of the Board of Trustees is to outperform a diversified benchmark. So you see at the upper right-hand part of this chart what our benchmark is. And it is very diversified. For example, we have 16% allocated to the Russell 1000 index, which is a measure of the stock market, the large capitalization stock market. And if you go on through, 6% to the Russell 2000 small capitalization stock market. We have international indices there, real estate indices, bond indices. And so it is a very diversified portfolio that the board has set up to measure itself against. And then the third goal that we have is to perform as well as our peers. So we use a peer universe that's supplied by our investment consultant, New England Pension Consultants, and we measure ourselves against 67 funds that are in excess of $1 billion. So the three bars that you see here, the dark blue one representing ERFC's return, the second one our benchmark, and the third one the public fund peer universe. So we were above the benchmark and our peer group for the 5 and 10-year periods. We've also met the 7.5% return for the 3 and the 5-year periods. For the 10-year period, we returned 7%, and as you know, that was a very difficult period because it includes 2008, 2009, so we're very pleased that we were able, in that significant down market, to come out with a return for the 10-year period of 10%. That was in the 30th percentile for our peer group, so we are happy about that. 30%, number one being number one. And we use both active and passive management to achieve these returns to build the most efficient portfolio. So for in those asset classes where we believe the market is efficient, in the equity market, large capitalization equity, efficient meaning there is much information out there. It's hard to have an information advantage. We do use some passive investment in that. We also use some passive investment on the bond side and core bond side. But our active management has proven the board well. And for example, for the 3-year period, you see the returns there that were in excess of our benchmark, 9% versus 8%. So on a net basis, that added $11 million to our returns. But it does, if we use active management, it does allow us to be a little bit more defensive in a down market. I want to spend a little bit of time on the board's risk assessment and what areas that they have to manage. They are assessing risk and taking measures to mitigate risk are important functions of the Board of Trustees, and they do look at risk in the 6 major areas that I have outlined here. The first one is, of course, the fact that we will underperform on the investment side. The second is that we will have unexpected liability increases due to mortality improvements or changes in our demographics. The third is, I'm sure you don't want either, unexpected budget surprises, that our contribution rate will be higher than forecast. Fourth, a disaster that would destroy our infrastructure. Very relevant topic today, breach of data security and a headline risk. So I'll go through a few of those areas of that the board looks at and see and let you know what risk management procedures they've put in place. The first, on the investment risk side, they do, as I have mentioned, have an investment consultant. They receive quarterly reports from that investment consultant that gives performance for various time periods. Also, risk statistics for the fund, for all of the investment managers. They also report on whether our investment managers are complying with their investment policies and objectives. When the trustees are considering hiring a new investment manager, they do a very thorough due diligence. We receive a list of candidates from our investment consultant. The staff vets those, and then the Board of Trustees interviews the finalists. And finally, the board does do asset allocation studies. They do asset liability studies. They determine if there's any areas where they want to change their asset allocation. For example, the board implemented a new fixed income strategy this year to mitigate against the risk of interest rates going up. We know that the interest rate reductions that we've seen over the previous years aren't going to happen in the future, that have greatly benefited the bond market. So this strategy, which adds shorter bond maturities, adds more diversification in terms of global bonds, the board implemented in order to mitigate the risk of interest rates rising. In terms of the risk of having unexpected budget surprises, The board has a funding policy. They have a goal to meet 100% funding, to have a stable employer contribution rate, and to still meet actuarial and their accounting standards. And to meet these goals, they do set contribution rates for a 2-year period so that the school board knows well in advance what our expected contribution rate is supposed to be. We do smooth asset changes over a 5-year period. So we right now have gains of $23 million sitting in the system, so that if there are some significant market declines in future years, we do have some cushion against those market declines. And then finally, as I mentioned, we do announce the contribution rates far in advance. Slide 20 shows some of the measures that we've put in place to protect us against breaches of data security. We do comply with Virginia Code Section 2.23803. All of our staff is required to, we have a standard operating procedure. We outline their requirements. They include collecting only necessary information, obtaining information directly from a member to the extent possible. We have confidentiality requirements. We have logs of every access to personal information within our system, so we can see who changed data, when it was changed, what it was changed to. And we have safeguards to ensure our system against threats to security. Our infrastructure has different layers. It's set up on 9 servers at the Network Operating Center, and they're monitored by FCPS technology staff and in accordance with the DIT guidelines. Our benefit administration retiree payroll system is Pension Gold, and our vendor for that system, LRS, was one of the first vendors in the country to have its application software tested for hackers. So they do that testing by an independent company on a quarterly basis. And we also have a business continuity and disaster recovery plan. We conduct a mock drill annually. And we do have the ability that if anything happened to the Network Operating Center, that our vendor LRS could run our retiree payroll in Springfield, Illinois. For our ERFC Direct service, our member online service, the member has to agree to comply with certain privacy and security policies and ERFC terms and conditions for use on the website. And that environment is also on the FCPS domain, but it's not connected to our full environment. So there's only certain ports open that would allow members to interact with the member services environment. And in terms of the risk of not keeping our contribution rates stable, we do show here on slide 22, the contribution rate history for the past 10 years. So our making progress toward the 100% funding, we're now at 78% funded. The average is about 71.5. That was reported in the latest 2014 National Conference of Public and Pension Retirement Systems study. We are higher than FCERS, who's at 75%, higher than the Virginia Retirement System at 65%. It does take some time for that funded ratio to improve, since, as I mentioned, we're recognizing gains over a 5-year period. Now, we do want to stabilize our employee contribution. You see that it's remained fairly stable for the last 5 years, up only 5% over that time frame. And just keep in mind that the 2012 to 2013 increase from 4.34 to 5.34, that's when employees began contributing to the Virginia retirement system, so the ERFC employee contribution was reduced from 4 to 3%. So when we do a new actuarial evaluation, the one we did in 2013, we recommended rates for 2016, 2017. So we are still recommending that 5.6% for the 2017 fiscal year. And if you look at the 5.6, but the 3 plus 3%, 8.6, that's really not out of line of what the contribution rate has been through the 40-year history of ERFC. The average for that time period is about 8%, so we haven't seen significant increases in the ERFC rate. And then the third goal that we have is, of course, to satisfy all the accounting and actuarial standards We did implement the new GASB standards last year, GASB 67. Fairfax County is going to have to implement the new GASB 68 standards this year. The liabilities that are going to have to be reported on the balance sheet are significant, $600 million for ERFC, which is a number that we've always carried in the notes, but now it will be put on the balance sheet of Fairfax County. The liability that will be put on the balance sheet for VRS, the last estimate that I've seen is $2.7 billion. So significant numbers placed on the balance sheet. The next area in the agenda was to show you what our historical expenses have been in terms of administrative expenses and investment expenses. Our administrative expenses, which are the dark blue bar, were higher in 2009 and 2010 than normal because we were putting in our new pension gold system during that time, so it does cover the expenditures for that system. However, we came back to more normal levels in 2011. And our 2015 administrative expenses are projected to be at the same level as they were back in 2013. This new system has helped us save personnel costs. Back when we started the system in 2009, we had an authorized staff count of 31, and now we are down to an authorized staff count of 27, despite the fact that our retirees have gone up and our membership has gone up. We're also processing payroll in-house now instead of having that outsourced, so we're saving $115,000 a year on payroll processing. We renegotiated our lease in 2012, so we saved $900,000 on that renegotiation of lease over a 10-year period. And we've brought many initiatives to paperless, so our member statements were no longer mailing out. So a lot of those paperless of initiatives have saved printing and postage costs as well. The light blue bars are investment expense, and we consider it a good thing that our investment expenses are going up because they are a percentage of assets, and as our assets increase, our investment expenses will go up. So the expense ratio has remained pretty stable at 0.7, but it really is because of the significant increase in assets that we've had since 2009. Our assets were $1.4 billion back in 2009, and we're now at $2.2 billion. So a 53% increase in assets has caused that increase in the dollars of investment expenses, but not an increase as a percentage. And then another way of looking at our fees in comparison to our peers, we show that on slide 25. Our administrative expenses of 5.7 basis points are lower than the average fund, which is 12.1. And our investment expenses at 57 basis points, a little bit higher than our peer group, but we do have allocations to private equity, real estate, and other alternatives that have a little bit higher fee schedule than our peer group does. But our total administrative and investment expenses at 62 basis points, very competitive. Other surveys have shown the average at 61, so we think we're really in the ballpark in our peer group. And this is in contrast to the average mutual fund investor who pays about 70 basis points, as recently reported in the Investment Company Fact Book. And then to finish up today's presentation, I did want to spend some time on the governance practices that the Board of Trustees has in place. The Board of Trustees is currently working with a consultant from Aon Hewitt to put together our 2015 strategic plan. And she went through our list of governance practices and was pleased to report that our board really has in place all of the practices that they should, and that many of the large state plans do not have some of the practices that our Board of Trustees have in place. So they have a board education policy, succession planning, standards of conduct, travel policy, new trustee orientation, and so forth. Just to highlight a couple, the board is conducting an actuarial experience study this year. They do that every 5 years to test whether their demographic assumptions need to be revised, whether the mortality tables need to be updated. The Society of Actuaries has just come out with a new 2014 mortality table, and though to all of us it's good if we live longer, it's not good to ERFC if people are living longer. So we will be taking a close look at those mortality tables this year to see if they need to be updated. then just to highlight some of the accomplishments that we've done during this fiscal year. The school board requested 2 years ago that we expand our communication program to make sure that our members understand the value of their retirement benefits. So we have established a school outreach program. We visited 18 schools during this past fiscal year, and we plan to expand that program next year. And we've also heavily promoted our ERFC Direct service, our member online service. So we currently have 17,500 members signed up for ERFC Direct, so they can do their own benefit estimates. They can go on there and establish beneficiaries. So it's really been well received by our members to have that service at their fingertips. We've also targeted some communications to different groups. So once a member reaches 5 years of service, we send a congratulatory email and tell them, congratulations, now you're vested, and suggest some things that they should be doing. And then finally, our 2016 initiatives. One of the things that the board has asked us to do is to develop an ERFC 2025 profile. So we'll look out 10 years and see what our average member is going to look like, what our average retiree will look like. We are planning continued expansion of our communications program. So not only our members know about the retirement program, but also our other stakeholders. We want to do a little bit more work on the economic flow-through of the ERFC benefit. We have given you the numbers on what portion of our benefits are paid in the Commonwealth of Virginia and what portion are paid in Fairfax County, but we want to make sure that we understand what the economic benefit of those dollars are. And we also plan to do more enhancement of our customer services.
Thank you so much for that very thorough presentation. I think we've all learned quite a great deal. I will start off with Ms. Schultz, who raised her hand. If anyone else has comments, please let me know. Thanks.
So if we could go to slide, if we could put slide 7 up, please. So if I understood you correctly, you were saying that in the difference between the last two and that final column, that's demonstrating if an ERFC contributor is putting in the minimum of 1%, and that really puts them behind the VRS2 plan. Is that correct?
That's correct.
How much was the employee contribution under the VRS2 plan in comparison?
5%.
So it would
in order to put in the max, they would have to put in 9% in the hybrid. That compares to 5%.
But I'm not talking about the third column. I'm talking about the second column.
5%.
So it's not. That's not remarkable that they would wind up less if they were at the 1% because they're not putting in the 5%. And then I think it's the next slide. Is this the one where we're talking about, the number of employees who were contributing, who were doing the minimum? Is the one more after this? Okay. So you had said that there were 1,088 members in that plan, and only 13 are doing at least the minimum?
Are doing more than the minimum. That's correct. So remember, the hybrid plan for the Virginia retirement system only went into effect January 1 of 2014. So that's in a year and a half. There have been 1,088 new hires.
Right.
And those new hires have to put in 1% to the defined contribution component. And they could put in an additional 4%.
And there's only 13 who are doing more?
We have done so.
I've got to imagine that's hugely problematic. And that's scary. So, I don't know what kind of education has to go into that, but and the reason that scares me was the next figure that you had, and I don't know that it's necessarily associated with the slide, but you said that there were 1,700 who are currently eligible for full retirement. Is that correct?
That's correct.
Okay, so they're currently working, they're eligible for full retirement. Let's say, and I don't know if you even know the answer to this, but what does the catastrophic plan look like if all 1,700 decide, you know what, I'm just done. They're all eligible. Does that affect the plan if in the next 12 to 18 months all 1,700 decide to? punch out?
It does affect the plan because we have actuarial assumptions, and
Right.
we have assumptions regarding how many will retire.
Right.
And so that would be, if they retire earlier than the actuary otherwise thought they were, that would be a cost to the plan.
But the actuarial would already have them retired because they're already eligible. I mean, how long
No, we don't assume that everybody that's eligible to retire retires immediately.
But you have to have assumed that some of that 1,700 would have retired.
We do.
I mean, isn't that
You would be
I don't-
surprised
I
how
don't
good the
have a-
actuaries are at predicting this.
Okay, so I don't have a stat on this, but it seems, as a percentage of our overall employees, 1,700, that's a lot of people who are eligible for full retirement who are choosing to stay. And I don't know, is that the economy that's causing them to stay? Are they looking for that, the last of the high 3-year, bump to get the highest amount? Or if they're already at full retirement, they're already at full retirement, it doesn't matter. But, 1,700 is a shocking number that they're hanging on.
Keep in mind that half of those are in the legacy, half of them are in ERFC 2001. To be eligible for retirement in ERFC 2001, you have to be age 60 with 5 years of service. So we have a lot of those second career folks that are in ERFC 2001. They're not going to get a very big benefit, so they're going to work longer. The slide showed that they're only going to get 20% of their final average salary if they work 8.5 years. So those individuals tend to stay longer than their full service eligibility.
So the definition of full retirement benefit isn't the 18 to 25 years. It's just that they've reached the age requirement?
Full service means in the legacy plan they're age 55 with more than 25 years of service, or they're age 65 with more than 5 years. If they're in their ERFC 2001 plan, they're age 60 with more than 5 years of service.
Okay.
So, I have numbers on the category. There's 500 in that first category that are 55 with more than 25 years of service.
That's still enormous.
That's a significant number.
Because I've got to think that there's got to be some kind of pulse taking going on with that many for you all to try to figure out how that impacts actuarials and how it could potentially impact the plan. Because if you have more than 500 in that first category, those are your big payouts. And if something, and I don't know what, but if there's some kind of messaging that happens in Fairfax County with the Board of Supervisors or anything, where they just kind of, there's a end of rope reaching, I'm just imagining that this is potentially very fiscally significant.
It's amazing that the assumptions that we have regarding requirements are very close. We do not have liability losses in the retirement system. In fact, it's been the opposite. For the 2014 actuarial evaluation that we just completed, we had a gain because people weren't retiring as quickly as we had predicted. And, it's hard to say why individuals are delaying. One, health insurance is extremely expensive if you retire before age 65. So, you could guess that many of those legacy plan members who are eligible are staying around because they're going to have to pay the full cost of health insurance.
Do you do any kind of pulse taking with that 1,700 to say, hey, they don't have to commit, but almost like a poll to understand, are you staying in to make the 65? Are you staying in because you're just endeared to the students that or whoever you're teaching or serving? Is it a downturn? What is it that is?
Yeah, our pulse taking is every 5 years. We look at the 5-year history. We see if the retirements are more than we expected, less than we expected, and we validate our actuarial earnings assumptions. During a survey to the active members and saying, are you going to retire, that is problematic.
Oh, so I got to imagine this is a huge HR issue, too. If we have that many people who are, quote, unquote, eligible, you just wonder what the pipeline is and how HR is prepared if we start shedding, because there was that dip, that 2008, 9, 10 dip. And if that starts to become an inverse and you start to see, shooting up escalation in numbers of retirees, where's the backstop for us, for new employees, professional development, handling that HR pipeline is going to be.
Okay,
I don't necessarily have anything else, but to me, a pulse taking of some other sort that's more robust for your understanding of where we are, I think is helpful all the way around.
okay, thank you, Ms. Schultz. Next, we have Ms. Strauss, to be followed by Mr. Stork.
Could you explain again the portability, the non-portability of the plan? I think you had just answered. One question I was going to have was vesting and the vesting rules. It's 60 with 5 years or, what have you. All right, so it depends on when you come in and years of service, and those rules depend on which plan you're in. And so what is the buyout if you leave FCPS?
If you leave with 5 or more years of service, you're entitled to a deferred vested benefit when you reach those eligibility dates.
Okay, so if you leave with 5 years of service, then deferred eligibility, so you don't get anything until?
Age 55 in the legacy plan,
Okay.
age 60 in
Okay, got
ERFC
it.
2001.
Okay, all right.
You're also entitled to leave with a refund of your accumulated contributions and interest.
Okay, wait, say that again?
You can also take a refund of your contributions plus interest
Plus
if
interest,
if you
okay.
leave FCPS before retirement.
Okay. And the minimum, everyone has to be in the plan with at least a minimum of a 1% contribution?
In the Virginia retirement system, the hybrid, you have to have
Yes.
1% into the defined contribution portion of that plan.
Okay. And if you were to compare this with TIA-CREF, which is what you see in in some of the private sector plans, how does this better, different, same, how does that compare?
TIA-CREF is a defined contribution plan, so that would again depend on contributions the employee makes during their career,
Okay.
what lump sum they have at retirement.
So then at retirement in TIA-CREF, is it a lump sum?
Yes.
At the end? Okay, all right, so that's, all right, and then the last question I have is that you had mentioned you were, one of your charts, you were using an annuity to get a number for the payout. I'm assuming that most of our retirees they're getting their payout directly from ERFC.
And VRS, that's correct. Right.
They're not turning
Having
around
to.
and buying an annuity with us.
That's right.
Right, because that would be an extra cost. That would be sort of.
So
off of
that only enters in the hybrid plan. So
Okay.
if you look at slide 7, that person that has put money into the hybrid plan, the max over all of the career, has $178,000.
Right.
So we wanted to take that $178,000 and make an apples and apples comparison
Okay,
among
all right,
all
that's
of the different plans. So in order to do that, we had to convert it to an annuity.
Okay, that was my question.
And we actually converted it to an annuity that increased at 3% like the ERFC benefit does. So we got quotes from Vanguard, but, interest rates are so low now, 10-year treasuries at 2%, so very expensive to convert lump sums to annuities currently.
Okay, all right, great, thank you.
Okay, thank you, Ms. Strauss. Mr. Stork?
Thank you. Why, I guess, you've kind of held steady at the same rate of contribution, the same funding of the liability. Any particular reason that you're staying at that level versus suggesting or recommending some kind of increase in fees or something else to get that higher?
To go above the 78%?
Mm-hmm.
The board has not recommended any increases in the contribution rate beyond what the actuary has recommended, so we're amortizing that unfunded liability over a 24-year period, and that is declining every year. So eventually it will be fully amortized.
I guess I would translate that to say that you're on a very, very, very gradual plane to get it to is it 85%? Is that your target, or 80, 90%? I mean, what's the intent? What's the board saying that they're guiding their officer to do?
We'd like to be at 100%.
So
That's always the goal, be 100% funded.
And you've identified you want to achieve that objective in 5 years, 10 years? Is there?
There's so many variables that go into your status, your investment return. It's a lot that goes into it, but we're always striving to get as close to 100% as possible. And your experience, your investment experience plays a big part of that. Sometimes there's a thought that if you have 2 or 3 years of good investment return, that can get you to a much higher status. It doesn't really work that way. It increases it sometimes, but it's very difficult to get that rate to where it needs to be. A lot of variables in place.
Yeah, I guess I would think that we'd want to be higher, and I realize it's not something you do tomorrow, you flip a switch, but it is something that you plan on, and the rate increases have been flat for some time, and I think part of it is the expectation, maybe not sure where the market was going and whether or not that would further add to but it seems like the rate of earnings is, because I know what at one time was 7.5%. Is it your trend line, your expected, is it 7% now? Have you changed that at all? Or?
No, we've stayed at the 7.5% rate.
And you're not, I know, was it last year didn't meet that, and I think there's some other years. Is that still a viable expectation that you'll hit that? Because that's the only way you get above the line you're on right now.
That is one of the things that the board's going to be looking at in the 5-year experience study, is whether they should keep their actuarial earnings rate assumption at 7.5%.
Yeah, that would be my concern in looking at this overall is I'm not so concerned about 100%, but I sure would like to be a lot higher than 78%, and I know that takes time and years to get there, and it's been 10 years since or almost 10 years, it will be 10 years for sure before we get at least into the 80s again, and we've had the rate flat for some time, and the assumptions you're using about what we expect the return to be haven't been met, at least for a couple of years. I'm trying to find this thing takes a while for my computer to load, so I flip to a page and it takes it a minute to load. But the ratio that you've been running the last few years is, if you could bring up the return, the 1, 3, and 5-year return. So I can't get to that quickly enough on my computer. It's right at the beginning, I think. I didn't write the slide down.
15.
Yes, I can't. Yeah, that's
So we
it.
have had
Thank you.
a
That's it.
9% return for the last 3 years. Also for the last 5 years, annualized return of 9%.
Okay, so we made probably just, I guess, was looking at the last year is all. Okay, so the average of
10-year
the last few years has been above the trend, the expected trend. And I guess, so are you anticipating that that will continue? Is that the reason that you're not looking at any other changes to try to get the liability to asset ratio higher? I'm uncomfortable with 78%. That's what I'm saying, and I know, and I believe you all are too. And I think you're trying to move that direction, but we've been in the 70s for some time now, and I guess I just want to have better confidence that you're looking at that and you have calculated when you think or how you think you're going to get to whatever that ideal ratio is.
Our latest actuarial projection shows us going above 80% in 2021, so that's 6 years from now. I mean, we're conscious of the other stressors in FCPS, and with the Virginia retirement system at 65% funded, and that being the primary retirement system for the FCPS employees, it's probably a more significant issue.
That's a fair analogy, but I reject that they're adequately funded, nor do I reject, and I also reject that the state legislature has done that properly. I think they've been cavalier, and I think they've been, frankly, it's not appropriate what they're doing. And borrowing it in the past is not appropriate either, but that's how they're playing the game with taxes, et cetera. But I don't want us to be doing that, and I think we can, at least when we point out what the state's doing, we can at least point to ourselves as the role model and the ideal, and I don't think we're there yet, which is part of what I'm raising this and why I'm challenging what we've been doing. And I was like you, I kept waiting, thinking, okay, the stock market will catch us up a little bit faster, but I don't, given the last few years, I don't see that now, and I don't hear that is something that if 2021 is best, that's not very far I mean, that's still a ways away, and that's at 80%. So on this track, you're looking at another 20 or 30 years to get to 90. I know actuaries aren't concerned about per se 100%, but there is some range that they have less confidence in what we're doing, and I think it's somewhere in the 80s is historically what I've heard. I don't know if that's true or
Yeah, I
not.
think they would be much more comfortable if we were somewhere in the 80s.
Yeah.
But, I mean, the board certainly will take your comments into consideration as we look at the
Yeah.
5-year actuarial experience study.
I'm not interested in penalizing employees, but I'm also not interested in having us, future employees, subsidizing future employees. I want to make everybody having contributed their fair share, and if we don't charge the current employees enough, then not only they're getting a benefit that they're not entitled to from future employees. So, the other thing I had was when you reference, just to be sure, when you reference passive investments, you're talking about index funds. Is that the measure that you're using?
That's right.
Any particular index funds that you use for that?
We do use the Russell 1000 index funds
Okay,
for
as
some of
you
our
put it
large
down.
capitalization
Those are-
stocks, and we use the Barclays Government Corporate Index
Okay.
for some of our bond
The
investments.
notes that you had on that slide there, I guess the notes you have on that, the Russell 1000 and the Russell 2000, and
Yes, if we use index funds, we're using one of those indices
Okay.
that were in the upper right-hand part of that chart.
okay. And now I'm going to ask a question. Well, actually, there's a dip in 2011 in the expense ratio. It just seemed odd. I didn't know what it was, and maybe you probably explained it at the time. I just don't recall what it was now. And again,
If you look at our calendar year returns, we had a decline in 2011. So this last 5-year period of robust returns, with the exception of 2011, was when there was a decline in the market. So
but
that
the
was what.
expense ratio went down. That's what I thought. I read that right. Yeah, expenses went down to, is that 0.6%? And those are percentage of the overall assets under management, right? So
Right.
if your expenses stayed the same and your
Assets went down.
so I'm assuming your expenses went down proportional to your assets. So maybe I'm confused on this, but it seemed odd. I couldn't figure that out. So the expenses for that year went down for some reason, and it's okay. I was curious about it because everything else was fairly consistent.
Well,
across
the
the board.
administrative expenses went down that year because we
That's
had.
what I was trying to figure out.
Yeah, that's it. We had fully paid for pension gold 2009 to 2010. Then the administrative expenses went down in that following year because we didn't have to make those capital expenditures.
Oh, so it's mostly, well, even capital expenses wouldn't do that because you're going to amortize over the number of years. So
The accountants wouldn't let us do that. That's what I argued.
but in business,
we
the
recognize
IRS
those.
doesn't let us do it any other way in business. We can't. I'd love to take that expense as a one-time, but I have to put it over a number of years.
We recognized it immediately, so we
Oh.
paid for all the pension gold.
You guys are allowed to do that. Okay. Well, hey,
I argued the other side of it.
I wish I could.
Okay, Mr. Stork, is that it?
The last thing, I don't need an answer on this today, but have you all considered other kinds of timing, other kinds of benefit tiering options? And I'll raise it. I think I know Michael and I have talked about this before, but new employees, when they come in, sometimes particularly if they're younger, have a difficult time contributing the same amount because of their own needs for disposable income, and having some sort of tiering process that would allow folks to join at one level and then kind of be bumped up in terms of their contribution levels at set periods of time. I mean, make it mandatory, but still have something that could allow them to. And I realize that would have obviously lots of actuarial consequences, et cetera, and benefit consequences, but.
The board has not had those discussions, mainly because that's what's happening with the Virginia retirement system.
Yeah,
So
with
that,
the individual
and
side.
that's the primary retirement system for the members, and they're allowed to put in 1% of pay, and then they can ratchet that up to 4% of pay as they can afford more contributions. So we didn't feel like that was a structure that really was needed for ERFC because it existed with the Virginia retirement system.
I fully support the defined benefit program. I think at least with the numbers we've talked about today, the value of that is I think unequivocal. So And I think where the state has gone clearly isn't working well for our retiree or future retirees anyways. And the expense ratios they have to pay is ridiculous. And that part of it needs to be changed regardless. That our VRS, when they're doing their individual retirement contributions, I think that needs to be done differently by the state.
Okay, thank you, Mr. Stork. So we have two members that need to speak, and we need to be done in about 5 minutes. So first, Ms. McLaughlin, then Ms. Evans.
I just want to quickly say that I really appreciate my colleague Dan Stork's questions, and I would hope that for the benefit of the board, that we can capture his questions in next steps. And Mr. Stork, what I would say is you've posited some, I think, really good considerations, and I don't want to lose sight of that. As we tend to have, as you know, very packed work sessions. So the notion of perhaps, and I think it goes to also your expertise as a businessman, to have those next steps reflect some of the things you've pointed to, recommended. I think it would be very beneficial that we look at trying to provide some answers to that. And it will allow us, I think, to be more productive as a board in support of ERFC's best work. But I feel like we got a lot of information put in front of us, and I'd like to feel that this was more than just an update, but that your time and ours, that we can hopefully have something, I guess, progressive that comes from it.
So thank you for that. But just to clarify, we don't do next steps for ERFC because they don't fall under the purview of our organization. However, they can always respond to Mr. Stork's questions. So that's perhaps the best format for doing so if you have anything specific.
I would guess I would ask then that we consider process-wise what was the point. We're having this presentation in our work session. If it's not within the purview of the board to do anything with how they operate or to provide input or guidance, then honestly, I don't. I have to feel like I want to understand the merits of. You've got 12 board members. You've got, 6 members from ERFC here. You've provided us a very detailed report. Mr. Stork has raised some good questions, and I don't want to just, that was part of the conversation, that was the end of it. So whatever the process needs to happen, I think there are next steps. The bottom line is this has taken board time. So if he's got some good recommendations, they don't have time today in this work session to respond to everything Mr. Stork said, the merits of it, and then how that, in the end, as someone who serves to govern this school system, if what he has brought forward has relevance to our employees and their retirement security, then I think we should be getting that information. In what form, I'll defer to either Superintendent Garza or Chairman Koufax, but this notion that there's no next steps and it is what it is, they can respond if they want to, I think that's a loss to the board, and it's quite frankly a loss to ERFC and all of its members.
Ms. Evans?
Yes. Thank you for the report. Given us a lot of very good information. I really just had one question, and that was about your outreach to schools, that you went to the 18 schools. I'm hoping you can tell us a little bit more about who you met with and what kind of a response you got. This was to let them know the benefit of ERFC, is that correct?
That's correct. So we would set up in the teacher's lounge. We went to elementary schools, middle schools, one high school. Mm-hmm. We would allow the members to stop in. We could do counseling one-on-one. We had IT people there so they could sign up for ERFC Direct. We would show them how to use the service and how to calculate run their own member benefits. So it ran the gamut from whatever questions our members had. It was very successful at Annandale High School.
Oh, okay.
We had lines. We set it up on a teacher work day.
Oh, good.
And we think that we're going to do more of that in the future because we had the greatest response there.
That's good to know.
We had a large number. But we would have one of our retirement counselors go, our communication specialist, Lisa, went, and an IT person generally. and would just have members stop in. And we advertised, we reached out to the principals of the schools, and so we're very welcome in all the locations that we went to this year. We also set up at Gatehouse and at Fairfax Ridge.
I don't know if this came up, but of course we reduced the employee contribution in 2012 with the idea that that would be more money in the pocket. But did that come up at all? I was wondering if people actually saw that or felt it, or did that come up, or has that been too long in the past for people to have seen when you went out to actually talk
I think
with them?
it was done at the same time that the Virginia retirement contribution at 5% was enacted,
Yes.
so
So they didn't
it was
see.
really an offset.
Okay, because we had hoped that would be a nice benefit, and I'm not sure. I think that may have gotten lost in the shuffle. Anyway, thank you very much.
Okay, thank you, Ms. Evans. And as for the, not next steps, but responses to the questions raised, how do you want to proceed?
Well, I think maybe what would be productive, Mr. Stork, if you would have time, I could meet with you and we could meet.
It's all right.
Michael, I can't think of your last name. Harrison. My gosh. Michael and I have known each other since my son's been in middle school. My son's nearly 21. So I just, excuse me for that. But Mr. Stork, if and then we can share that we can share the results of that meeting with the board. Would that be?
I don't know what the board wants to do overall. I think the issue of the liability assets ratio and what that means, I think the board overall should be concerned about that and where it's gone. So I don't know if that's, I think that would be a response to the board overall if the board wants that. If it's just me, then I would agree. I'll meet with them and I'll be happy to do that. So I don't want to speak for the whole board, but for myself, I want to understand better where.
Well, I think if we're going to ask them to present that, the whole board should know that. So I guess I would kind of look at kind of head nods if that's something, some of the questions that Mr. Stork raised, if people overall feel that that's important, and we can then work together, which I think is probably the best way to proceed at this point. Yes, heads nods, board. Sure. Okay, Megan, I'm sorry, I hijacked Ryan's session. Go ahead.
Ms. Smith first.
Okay, so when you talk about those slides and you talk about the liability and the debt and base it in how much you can get the school system to pay in, it is really complex, especially in the situation we are with our budget. So maybe it's something the board needs to know more about. To me, this isn't a priority to have a discussion about that right now. It might be something we do in the future, but we've got so much other stuff with the budget and those pieces. To me, this isn't a priority to have another presentation about that right now.
Okay, Ms. McLaughlin, did you have something?
Yeah, I guess because it was my question that I'd asked about as a next step. So I understand what Chairman Koufax is saying, but I was trying to actually make it even easier than that. It's Mr. Stork raised several questions and comments during this work session, and if we just capture the questions that Mr. Stork raised, and then we send it over to ERFC to respond in writing, it doesn't require Chairman Koufax, Mr. Stork, and Mr. Harrison to spend time in a meeting, and then somebody's got to write that up. Just here's some of his recommendations he presented at the work session, and you guys can take that time to respond to that input he provided and the questions he presented, and then it can just be filtered back out to the board. But maybe it doesn't interest all 12 of us, and that's totally okay. I mean, we've got to divide and conquer our focus anyway. But I feel like we spent all this time listening to the presentation, and quite frankly, I want to understand what the takeaway is. And I also think Ms. Schultz raised some questions too about that. And so in my mind, to make this time meaningful, Ms. Schultz asked some questions, Mr. Stork answered the questions. We have staff who's taking minutes of this entire conversation. To not just have those questions forward to ERFC and they can respond would be a loss. That's my recommendation.
Mr. Hairston, you wanted to make a comment?
Well, two things. The questions and the observations that you've made, we will make sure that the board is aware of it, and we'll flesh it out and try to get some answers and get at least some type of response back to you in a reasonable amount of time. And on a positive note, I just want to personally, on behalf of the board, thank you for always following the actuary's recommended contribution rate consistently since the inception of the plan. You've always funded that, whatever that rate was, you certainly funded it at that rate, and that makes a huge difference. Just another comment of getting the funded ratio up. There are a lot of variables that go into that, but that would probably mean some increases in the contribution rates. Given our fiscal situation, that may be something that just something for you to think about.
Okay, so with that, as Mr. Hairston stated, he will be getting responses, or the organization will get responses back to you on those questions. So with that, this work session is adjourned. We will be moving forward with, which one now? Are we going to do governance? Or
No, I have just had a conversation
Okay.
with Ms. Evans and not to do that. So we'll go to a strategic planning work session in about a couple of minutes. I think they need to change the tape. I have already had that conversation with Ms. Evans. She's not. Okay.
Okay, thank you.